continue with the impact of crypto assets on financial portfolios, and Felix Fernandez from 21E6 Capital. Hi, welcome.
Hi, thank you. Okay, that's good. Yeah, so good afternoon, everybody. It's good to see a fuller room, and hopefully you are all awake now. I think, I don't know where's Max, but I did here with a very energizing intro. And I'm happy to follow up on a topic that you also mentioned, which is the impact of crypto assets on financial portfolios. Quick intro to myself, Felix Fernandez is my name. I have a longer background in the financial industry, worked 20 years for Deutsche Börse Group, so I know quite well the let's say market operator side and the exchange participation and product side. And since 2016, I decided to, if you want, go back to a drawing board and created jointly with another partner a spin-off at ETH Zurich. So I moved from Frankfurt to Zurich after many years. Was also a quite good experience, sometimes to change home base. Since last year, January of last year, I'm involved with 21E6. Just to get this out of the way, this question comes almost every presentation we're making. So 21E6 stands for 21 million, and probably most of you will know what this means. So coming to 21E6. 21E6 is an investment advisor based in Switzerland. And what we are doing is we are basically designing investment solutions for professional customers, institutional customers, and also very happy to launch in the next weeks our first product, a flagship product, which will be a crypto fund of fund. And today I wanted to give you a little bit of a crash course in portfolio modeling to see what happens when you add crypto to a portfolio. And the good news, there will be no math involved, so no fears. So typically you have, and I just picked probably the most common issues that you're having or challenges that you're having with integrating crypto, which is volatility. I think many speakers had touched on that base, which when, let's say, these questions started in academia, it's maybe in 2017 or so, where you read the first papers on how to integrate crypto into, or at that time it was Bitcoin, into a portfolio. There were many attempts to find solutions and how to do that and how you can integrate it in financial models and so forth, and showing up the challenges. Extremely correlated with it, extreme drawdowns. You have the drawdowns which are not sustainable from an investor perspective if you're purely at crypto. And also within this universe, but this is very typical for a universe, in this case like cryptos, but it's the same or similar in equity, where you have a high correlation within this universe. What I wanted to show you today are basically three approaches on how to solve that and how to tackle that. And the first one, sorry, maybe I was too fast, crypto downscaling, which means that you have just to align the scale, then strategic asset allocation and rebalancing, so how this affects your portfolio, and last but not least, how you can diversify over style. So crypto downscaling. So first, what you can see here, this chart, I mean, most of you know that. This is here Bitcoin against gold and against global equity. And the important message here, what you can see, that the dimensions are completely out of range. So on immediate view, you would say, how the hell can I integrate this into a portfolio? How do I manage that? And there is a very simple approach of doing that, which is downscaling. So most of you have heard about leverage. This is what hedge funds do typically. But there is also a deleveraging. And when you deleverage Bitcoin, it becomes by far and large more comparable. So this is just 10% exposure of Bitcoin. And what I've chosen here, the 10% is just a little bit of a rule of thumb, is that you are getting very close to the volatility of traditional asset classes. And then it becomes far more comparable. And what you can see here, this is basically the black line here is Bitcoin, the green line is global equity, and the red line is gold. And what you can see here is that they're very similar in their overall behavior. And if you look deeper into it, and we will just see it in a minute, is that now you can start constructing a portfolio. And it gives you also a little bit of an indication what your, let's say, maximum percentage is that you should add to a portfolio. So what is basically recommendable to do just from a, let's say, purely quantitative perspective. Yeah? So I'm not doing any assessment here about the one or the other token. It's just, and Bitcoin, I'm taking Bitcoin because we have the longest data and the data are quite reliable. And it's, of course, still the benchmark from that perspective. But it helps to, again, to correct the perspective and to scale it down. Now, I hope you can somehow, probably the figures, yeah, well, okay, probably they're readable. What I wanted to show here, this is a profile, a risk-return profile, and probably you have heard many times Sharpe ratio, risk-adjusted returns, and this is sometimes a little bit of an abstract term of saying, okay, what is that? Yeah, so what is a Sharpe ratio? Well, basically, it's the point where you see here the different assets. So the black label here, BTC 0.1, means 10% Bitcoin exposure. And these dotted lines are the Sharpe ratio lines. So the line which is close to BTC is the Sharpe ratio 1. The next one to the left would be then 2, and the next one 3. And why is this the case? Well, basically what you're doing is you are normalizing your returns in contrast to the volatility that this asset has. Why? Well, returns per se are difficult to compare. So if you compare return of a bond, of course it's different than equity, but it also involves different risks. Now, it's always important to see this in a context. And when you look at here at the Sharpe ratio, and there's also a rule of thumb that you have roughly a Sharpe ratio which is 2 times the Sharpe ratio of equity, of global equity. Yeah, so you see here on the bottom frame, it's 0.6 approximately, 0.59, and Bitcoin is 0.1. Sorry, 1.1. Yeah, so it's roughly 2 times the Sharpe ratio. What does this mean is that for the same risk, you are getting a higher compensation. That's it. So from that perspective, it makes a lot of sense to invest in crypto, even if you, let's say, don't, let's say, think about selection process and which cryptos you want to include, but just looking at cryptos, and the behavior is relatively similar across the board, at least for the time being, that you have an interesting asset just from that perspective. So it's heavily interesting to have that in the portfolio. Now, this was one point with regard to downscaling. So it's important to understand to just bring the volatility down so that you can have it in a context where you can compare it. The next topic, strategic asset allocation and rebalancing. Why is this important? Well, you can just learn from pension funds. What pension funds do, they control their risk by creating risk buckets. So they say, for example, I have X% of equity, depending a little bit on regulation. They have anything around, let's say, 40% in Switzerland, for example. Then they have a significant portion of bonds, which is, let's say roughly, let's say 50%, and the rest is across, can be diversified across different asset classes. And why is rebalancing important? Rebalancing is important because you have to keep your risk buckets constant. So it's a big mistake to ignore rebalancing. And many people say, well, okay, but if I'm rebalancing, I'm losing performance. And the answer typically is yes. But you also are reducing your losses as the concentration is not so high. So what happens if you just would leave, you would just buy a certain percentage of Bitcoin and leave it in your portfolio? Let's assume that it grows in the same path or the same manner as it has grown in the last years, then Bitcoin would dominate your portfolio. And then you have, from a risk perspective, an unbalanced portfolio. Therefore, rebalancing is very important. I apologize for these involved slides, but I will try a little bit of our coming, if you want, out of our lab. Yeah? So it's really our working material. And I wanted to share it as it is. I would start, and all the rest is built the same. Yeah? So basically, if you understand one chart, all the others will be in the same logic. So first of all, what we're showing here is the effect of diversification. When you look at, we start with Bitcoin, with this violet line on the top, and you see the performance. And also on a side note, if you compare, in general, if you compare performance of assets, please do it on a log scale. Never on a linear scale. This leads to completely erratic or wrong visualization. So what you can see here is the violet line, which is Bitcoin on the top. And then you have, we created here a benchmark, crypto benchmark, which is a portfolio of 10 cryptos. You can see this here, this Bitcoin, Ether, Binance, Polkadot, BCH, and so forth. So there are several tokens here, which are used for a portfolio. Why we're doing that? Because it's generally recommendable to have a diversified portfolio, which does not mean that it behaves, at least for the time being, very much different. So the waterfall diagram on the bottom shows you the weights over time. And you see that it starts purely with Bitcoin, and then all the others are coming in. And at the end of this journey, you see that we have all the 10. And this is a portfolio which is not purely driven by market cap. If we would use market cap solely, it would be dominated by Ether and Bitcoin. Why I'm showing this, if you look here at the drawdowns, this is the middle layer. What you see here is that the drawdowns of both universes are substantial, which means that if you are within a universe, if you're within one asset class, and this is the same for equity, diversification is a critical thing on one side, but it does not protect you against the movements of the whole universe. So if the whole asset universe moves downwards, well, almost all instruments in this universe will move also downwards. Now, if you are now adding crypto to a portfolio, the naive idea could be, well, that's phenomenal. I have a sensational Sharpe ratio. Why don't I just invest 50% in crypto? Now, this is the example here. So the blue line is a very, let's say, typical construction, 70-30. You probably have heard about this when you looked at, for example, robo-advisors or any recommendation from your investment advisor or your bank, how to invest. When you want to have a significant exposure to equity markets, it's 70-30 as a rule of thumb. Now, if you add, in this case, 50% of crypto, so you take out a portion of equities and you take out a portion of bonds, and you invest in crypto, you are getting the green line. And what you immediately can see, and this is the bad news here, the drawdowns are quite severe. Why? Because Bitcoins, in this case, or the crypto portfolio, they dominate your traditional portfolio. Again, remember what we said in the beginning. You are so far away in terms of volatility and returns that this volatility especially impacts your portfolio massively. So you have to scale that down. And this is basically what we do in a strategic asset allocation. Now, a much better picture is when you add just 4%. I mean, there is, of course, a certain bandwidth. You can decide how much you want to include into a portfolio. Typically, what we see is that 4% is, as a rule of thumb, a very good level, because it typically does not change the risk, the risk profile of your portfolio massively, but it improves the Sharpe ratio and it improves the returns. And I mean, let's go a little bit deeper into that. If you look at the top line here, you have an annualized return of your traditional portfolio of 9%. Very much in line with what, let's say, you would get with global equity by adding this fraction of bonds to it. A certain volatility and a Sharpe ratio at 0.8 approximately, and drawdowns of approximately 25%. Drawdowns are probably the most important risk parameter for investors. And I mean, this is basically for all of you, let's say everybody who has lost money when investing in a stock or whatever, let's say venture. Losing is never good, and we are quite sensitive to that. But also there is an inherent problem with drawdowns, which are the asymmetry. So, which means that if you lose money, you have to recover if you want to just get back to where you are. And a very simple math is to show this asymmetry is if you're losing 50% of your portfolio, you have to regain 100% to just get back to where you were. So, and this asymmetry is very critical. Therefore, drawdown protection is probably one of the most important things that are relevant for portfolio construction. And when you look at the drawdowns, basically the green line and the blue line, especially when you look at here, and this is a topic will touch in a minute about correlation, during this COVID crisis in the equity market, basically crypto went with it. And this is a little bit of a problem that correlations are not stable. But again, the message here, adding a small percentage to a portfolio generally helps. It can be anything between 1% and 4%. Style diversification is another dimension, but before I go into style, something that is a little bit derived from that. Why style diversification is an additional dimension that you're having is looking at correlation. If you look here at the correlation, this is correlation between Bitcoin, gold, and global equity. And on the bottom left, you see this blue dots. These are basically the returns. These are weekly returns for this time window of 2014 until now. And you see that they are somehow in a circle. Yeah, so it's a little bit of an unclear shape, but it generally means that the correlation is low, and you see this in this red line. The red line is a regression line between these points. And you see also the figures, that the figures are at approximately 0.1, which means correlation is low. Normally would say, fantastic, that's good news. I can add it to my portfolio. And low correlation means that when one asset goes up, the other goes down, or maybe does not move. Unfortunately, this is another view, which is rolling correlation. So the message here is correlation is not stable. It moves from negative to positive. Unfortunately, we cannot predict this, how it behaves. It would be perfect if we could. And the other thing is that typically during market crisis, the correlation tends to increase. The reason for that is that investors then are looking for safe havens, which is liquidity. So they're selling off their assets regardless where they are. And that doesn't matter if it's crypto or bonds and so forth. This is versus gold, Bitcoin versus gold. You see a similar picture. And the last bit of my presentation is why it makes sense to add styles. Well, this is the advantage when you invest in funds. When you just invest in the spot market, you have basically two dimensions, which are trend and volatility, and you can try to diversify within this universe. If you add styles, and these styles emerge from what basically the managers are doing, yeah? So they are doing either market neutral styles, like say market making or arbitrage, or they go for, let's say, more long strategies, which means that they have a certain beta, so they work or go along with the market. And when you combine these two, you are getting a significant advantage, which is that you can control your Sharpe ratio within a certain range. And I will show you how this works. So you see here on the upper right hand, you see a fund universe, which is pure beta. And on the upper left, on the left downside here, you see a universe which is market neutral. And what you can do is you can combine a fraction of it. So it's rather, let's say, for example, 50%, you would have a point in between these 2 points. And you see that the other asset classes, how they behave in this region. Bitcoin, by the way, you see here has also relatively high Sharpe ratio, but also high volatility.
Felix,
yeah,
I need to wrap up now.
Yeah, thank you, just at the end. So important, downscaling if you compare cryptos. Look at your strategic asset allocation, do a proper rebalancing. If you can, add styles. And please don't use linear scales. And if you do an error, then error to the safe side. Yeah, so to add more market neutral components or less beta risk. And important last point, correlation is not stable. Please take care of that. Thank you very much.